Ladies and gentlemen, welcome back to the regulatory news channel of PwC, the CRR channel. My name is Martin.neisen and I'm your host for today. I'm a partner with PwC here in Frankfurt, leading the Risk and Regulation department, and apart from that, I'm also leading the Global Basel IV initiative. Today, we are going to speak again about the European Banking Package 2021, which was published as a draft in the end of October this year. And today we will pick out again one very important topic where we go more into the details, and will focus on the CRR, and here we'll focus on credit risk, and here today the main topic is the new standardized approach. Like always, I'm not going into the details alone. I have two colleagues today with me from the PwC Luxembourg office. It's Aude.payan and Jean-Philippe Maes. Wie geht het?
Moin Martin, mir geht es ganz gut.
Great. Jean-Philippe, I have directly the first question for you. There are really a big number of changes in the standardized approach for credit risk. And before this approach was actually published by the Basel Committee, there were a lot of discussions because especially the regulators, they asked for a much higher risk sensitivity for the new standardized approach. What is your impression? Were they able to achieve this higher risk sensitivity?
Well, thank you for the question, Martin. Overall, I would say yes, that is mission accomplished. But hopefully, well, thankfully, actually, it's not gone as far as some wanted it to go back 7 or so years ago when the first versions of Basel IV were dreamt of. Because you might remember that initially they almost wanted banks to become a substitute to credit rating agencies and have their own financial analysis department internally. So clearly it has not gone to that extent, and that's good for, of course, for the banking sector. But yes, I think what has been put in place is clearly more sensitive. As we'll see, sadly, for some banks, it might mean higher risk weights. For others, some good news.
Okay, great. Then I would suggest we directly go a little bit more into the details. Maybe you can explain to us what are the biggest changes overall for the standardized approach for credit risk?
Yes. So in addition to what I've just discussed or hinted at, which is the sensitivity, it goes mostly through due diligence expectations, really, to at least challenge or validate external ratings, so not follow them blindly. We'll get back into a bit more details. We'll also see a connection with probably the expectations that came into force this summer about loan origination and monitoring, because there's a connection there. That would be the first point, so this kind of due diligence aspect. The second point is clearly to do with real estate exposures. That is significantly overhauled with redefinition of the subclasses of exposure, income producing real estate, land acquisition, development and construction, for example, and others. So the rules are certainly changing there. So that would be the second point, real estate. And the third and last point I think I would put forward is really an increase in risk weights for anything to do with equity exposures and subordinated debt exposures, where we see, an increase in risk weights, as I said, but also a return to the more substance over form kind of definition. It's no longer just because an equity is called an equity that it will be risk weighted at one level or another. It's really to look at what is the underlying substance of that. So clearly there it can have a very substantial impact. And I'll just cite one just to get the audience clear on that. Today, typically, you have an equity exposure, 100% risk weight, let's say by default, that would be the rule. Well, the new by default rule will be 250%, but it could go all the way to 400%, okay? And only under some strict circumstances can you go back down to 100%, okay? So that's all depending on the features of the exposures, but that's just to show that it can have a significant increase on the risk-weighted assets.
Okay, thanks a lot, JP. So this shows already like that there are really fundamental changes in the standardized approach for credit risk. And you were mentioning the external ratings. Yeah, maybe we stick to that topic a little bit more because it's a really interesting topic. I mean, the current standardized approach heavily depends on external ratings. Yeah, you derive based on the external rating the risk weight. That was heavily criticized, especially during the financial crisis, because everybody was mistrusting the external rating agencies. Were the regulators able to address that problem and the criticism of the external rating agencies?
So yes, but not fully, let's say. So for me, what we have now is a good start, and we were referring before to the due diligence requirements. I was also referring to loan origination and monitoring, and that part has certainly been enforced quite substantially over the last few months and years. But however, it doesn't really go very far in terms of what are the detailed requirements for this due diligence. So my take is that this will become more a market practice, probably more enforced via Pillar 2 measures, on-site inspections, SREP measures, and all more regulatory guidance to come. But at the moment, let's say banks are a bit left to their own devices to decide what they should do in terms of a pure due diligence requirement. Maybe one thing I'd like to add is that where we stand today, and we'll get back to some specifics later on, especially about banks and corporates, but more generally, interestingly enough, it's, I believe, for the first time that in a CRR text, there's actually a call for all three European authorities, so the ESMA, EIOPA, and European Banking Authority, to actually sit together and come back with more details as to how to handle ratings in going forward. And I'll take one example, is that they open the door that more restrictive or specific measures be enforced in the future, typically for unrated corporates or even rated ones, but maybe to base it more on, let's say, sector and geographies of those corporates, for example, something that's totally inexistent today. So that's basically what I would say to address your question, Martin.
Okay, thank you very much. So we can say something like, yes, they addressed the problem, but the problem is not fully solved yet. Yeah. So we can say it like this. Yeah.
Watch the space.
Yeah. I have another question regarding the external ratings, but here more specifically to the exposures against other banks, because a big number of banks within the European Union is still unrated. Yeah? Maybe you can say a few words on that. How are unrated banks addressed now in the CRR III?
Well, thanks. I think there we can talk of a mini revolution, I would say. Both in terms of approach and in terms of risk weights. In terms of approach, because unrated banks, especially, will be subdivided now into 3+ categories, and I'll come to the plus in a moment. You'll have grade A, B, and C for banks. Okay, so this is a new concept. Those grades did not exist before. And they define grade A as those banks that are completely healthy, that are completely adequately capitalized, or no liquidity issues, and they basically meet all their combined buffer requirements. You remember from Basel III, the combined buffer, countercyclical buffer, and the others. So, and so long as that information is available somewhere, and we can discuss that actually a bit more later on, you could consider that exposure towards that bank as grade A. Grade B is when your counterparty, your banking counterparty, starts to become exposed to substantial credit risk. So that's where things are less so sure. They still meet the minimum capital requirements, but not necessarily the combined buffer, or they're within the buffer. Again, like for grade A, where do you easily find that information? From an operational standpoint, I think that's important to bear in mind. But that would be for grade B, so there's some doubt about the ability to resist to changing market conditions. And grade C clearly is the one where there's a material default risk of your counterparty, and that any change in the macroeconomic or in the sector conditions could really make that bank tilt into a dire situation. Another interesting thing is that where the external auditor has issued a negative audit opinion. That is another example of where a bank would be in grade C. So that's A, B, and C, and I said 3+ at the beginning. Because for me, there's kind of a new AA, AAA, whatever you want to call it, which is the case of actually the very good examples in this world. Because if you can demonstrate that your banking counterparty has a CET1 ratio above 14% and a leverage ratio above 5%, then it qualifies for this top quality type of exposure. For us in Luxembourg, for example, that would be the case of many of our banks, by the way. Our average ratio is above 25% in the country, for example. Yes, so that's how it would work. Now I can elaborate a bit, if you want, Martin, what it means a bit in terms of risk weight compared to the current situation. Sure. Without going into details, but clearly there's difference still, like in the past, between short-term exposures and longer term. Short-term, still less than 3 months. Okay, that's the definition doesn't change. There, it's the only way in a short-term exposure with a grade A bank to get to the 20% that is currently applicable for bank exposures. Because if you go above 3 months maturity, the minimum becomes 40%. Okay, so a doubling basically of the current risk weight. If you go to the other extreme and take a grade C bank, short term is actually quite reasonable. It's 75% risk weight, so it's no longer a 150 like we had in the past. But the 150 remains applicable, however, for a grade C long term. Okay, the only way for long-term exposure to go below the 40%, this new 40% minimum, is for those AA banks that I said that are the gold standard, let's say, and they can go down then to a risk weight of 30%. So that's clearly quite a significant change for exposure to banks. That's my bottom line.
Yeah, thank you very much, JP. That's incredible, because this will definitely have a significant impact also on the interbank business. Because currently, as you mentioned before, the typical risk weight for European unrated banks is 20%, and it will increase at least to 30% or even 40%. And that is 50% more or even double capital requirements, and that must be included in the pricing, as you mentioned, within the EBA loan origination guideline. So that might be a significant impact. I have another question, but this time regarding a completely different exposure class, and Aude, maybe you can answer me that. It's about specialized lending. Currently, in the existing standardized approach, there is no exposure class, specialized lending, so it's completely new. And in the new CRR III, there's a differentiation between object finance, project finance, and commodity finance. What is the background behind that, and can you give us a quick overview how to calculate the risk weights for these exposures?
Yes, sure. Thank you, Martin. So indeed, the CRR III programmed and set up 3 classes for specialized lending, which are project finance, object finance, and commodities financing. So project, to be short on the definition, is when a bank finances a project, so the implementation or the acquisition of a power plant or a mine, for example. Object finance is when a bank finances some assets such as planes or boats, ships, etc. And commodities finance is when a bank finances the short-term reserve of some commodities, so actual commodities. And why they introduce such new classes and how we calculate the risk weight is to really, to the first point, increase and be a bit more transparent on increase the risk sensitivity. So really be closer to the reality when you calculate a risk weight and probability of default for such exposures. So if I want to detail a bit on the risk weight, so for project finance, the risk weight can be between 80 and 130%. The 130 risk weight will be for when the project is under pre-operational phase, which lasts only a couple of months, while after you can risk weight your exposure between 80 and 100%. The 80 and 100 depends on the quality of the transaction. So if the bank really knows the project and have really been exposed and experienced with such projects, they can easily quote the transaction at 80% risk weight, while now it was still 100% in any case. For object finance, it's also between 80 and 100%. And again, right now it's all under 100% risk weight, so it's a very good plus for the banks that can leverage from their past experience and lending to such project and object finance financing, I guess. And for commodities, it's at 100% in any case, and this doesn't change since CRR2. But really what we wanted to highlight here for you today is the impact on the 80%, which is new under CRR3, and that is very beneficial for the banks because it builds up on what they've been lending to, and how the risk weight can change from 100% to 80% now is a very good plus for their capital adequacy ratio.
Thank you very much, Aude. I have an additional question regarding specialized lending. Specialized lending is a new topic for the standardized approach banks, while for the IRB banks, it exists already for a long time. Do you think that especially the smaller banks that are using currently the standardized approach will maybe have a problem to identify these specialized lending exposures? Because it's a regulatory definition?
So identification may be a new topic for the banks using the standardized approach. However, it's really well prescribed by CRR3 from the introduction of CRR and the way the European Union has been trying to really focus on banking for the European institution and not at global level. It's really between the Basel text and in the CRR3 really well defined on what is an exposure for specialized lending, what is an object finance exposure, project finance, and in which case, and what are the income related criteria that the bank should look at when identifying such exposures.
Mm. Thank you very much, Aude. JP, I have another question on you, and that question goes into the direction of real estate exposures, because there, at least that's my understanding, also everything is going to change, not only for residential mortgages, also for commercial mortgages. And if I understood it correctly, there's also a new category of real estate exposures introduced, and that are the income-producing real estate, both for commercial and for residential. Maybe you can say a few words about that. What are the major changes, and what do you think what the impact might be?
Okay, thank you very much for the question, Martin. Actually, I'll start with your last point I just raised. Income producing real estate. IPRE is the new acronym for that one. New class, indeed. And the bad news there is that automatically the risk weight for such class is 150%. Okay, so that's already a steep increase compared to what is in place today. So that's the first one we can talk about. However, the more generally, so there are some significant changes for broader real estate considerations other than income-producing ones. So the credit splitting concept continues to exist, and there the general rule, while a series of conditions are met, is that you can apply a risk weight of 20%, so very generous, let's say, compared to the minimum 35% that we see today. But that 20% risk weight will only apply on the first 55% of the loan exposure, okay, compared to the property value. So that is quite limited, let's say, in terms of impact. So the risk weight is good, but the proportion of which it covers is actually quite restrictive. Okay, the remaining part, the remaining 45%, then becomes exposed to a physical, natural person or a corporate, depending on the nature of the counterparty. So that's the best case, let's say. Because if you don't meet those strict conditions, then we need to start looking at a relatively new concept, which is the exposure to value, where all Basel III was talking about was loan to value. So here it's a bit a different definition, because this exposure to value, of course, it's the ratio between the gross exposure amount, including any undrawn but committed amount, okay? And you divide that by the property value, of course, following some conditions. I'll get back to that. This exposure to value then becomes the main criteria to look up in your risk weight tables, which risk weight should apply. And just to keep it short, for residential real estate, in the best case, the risk weight will be 30%, but it can go all the way to 105%, depending on how good or bad this exposure to value is. If you move into the commercial real estate world, it starts at 70, all the way to 110%. So that's just to give you a bit the extremes. One thing I would like to add that's quite useful for us, at least in Luxembourg, is something that's caused questions in the past, is that at least this time, on the good news side, any pledged deposits that you may have with the bank, on the liability side of the bank, can actually now is explicitly eligible to reduce this exposure amount. Something that will be quite welcomed by our banks locally. So maybe the last point that I want to cover about real estate exposures is that those risk weights that I've just explained really quickly could be changing in the future. Why? Because all member states are to designate an official authority, a public body, that will annually have to assess whether those risk rates are still adequate. And they will have to base that analysis on the actual recent loss experience in the real estate sector. That's the first criterion. The second one, any forward-looking market developments that could be relevant. And I think that is quite a big change, especially in some geographies today. So that's what I had to say about real estate exposures, Martin.
Okay, thank you very much, JP. So there are a lot of new detailed requirements that banks have to fulfill, and given the fact that the real estate portfolio is mostly one of the biggest portfolios of a bank, I think it's very important that the banks make an in-depth analysis what the impact of these new rules might be. And summarizing a little bit of what I just heard from you, I think it's fair to say that the regulators tried to achieve this additional risk sensitivity, especially in this exposure class. Because when you compare traditional residential real estate mortgages, there the risk weights are still quite low, while for income producing commercial real estate, which is definitely more risky, the risk weights go up. So there is definitely more risk sensitivity as in the past. Maybe the last question for today, Aude, goes into your direction. I mean, you're of course of PwC Luxembourg, so there might be some specific impacts on the Luxembourg bank market. Maybe you can give a quick overview of how Luxembourg banks are impacted by these proposals coming from the EU Commission.
Yes, sure. So we've tried to summarize in a table what are the different, how the different rules, the new rules impact the four models of banks in Luxembourg. So just as an introduction for anyone who does not know that well the Luxembourg banking industry, we have four typical business models for banks here in Luxembourg. The more universal bank, which lends to all communities, to retail person, and which are really the major banking actor here in Luxembourg. The private bank, the custodian banks, and the supranational and the multilateral development banks. So really, these are the banks for the EU institution, which have a very specific business model and specific lending exposures that we will not find in other types of banks here in Luxembourg. So pretty much all items will impact the banks in Luxembourg, but where we want to draw your attention is that, for example, the real estate the new rules for real estate risk weights apply and are very impacted by so in the universal banks, because it's really the banks that lends to the communities and to the project financer as well for real estate, whether it's commercial or residential buildings. So it really affects a lot of the capital ratio for our banks here in Luxembourg. And another interesting one is the project and object finance. So really the specialized lending category, which will affect mostly, again, the universal bank, which lend to such economic projects and to to raise the economy of the European Union and mostly in Luxembourg, and also to the supranational and multilateral development banks that themselves will invest in object finance, project finance, and commodities financing more at global level. So this will be impacted as well here. Another item, if I may, is that impacts banks in Luxembourg, but also it's for any country and any new banks in the European Union. It's really something we haven't discussed about yet, is the new minimum, so the credit conversion factor for off-balance sheet exposure, which goes up to, which is now the minimum of 10%, while as of now under CRR II and CRR I it was 0%. So all the off-balance sheet items, so the credit facilities and credit lines, will now be credit converted at 10% instead of 0% when they were revocable without notice to the clients. And that will affect, because usually the banks have a lot on off-balance sheet on credit lines. So it's really important for the banks to consider that and to put a bit more capital aside for that.
Thank you very much, Aude. Thank you very much, JP, for these really interesting in-depth analysis of the proposals of the CRR III regarding the standardized approach for credit risk. It seems like that there's really a fundamental change. So I would like to thank you, dear viewers, for your attention, for watching this video. If you have any further questions, do not hesitate to reach out to your local PwC contact. We have included a link to the Basel IV webpage of PwC in this YouTube video. So whenever you have any question, click on the link and you see all the contact persons for whole Europe, but even on a global level. So thank you very much again, and thank you very much, Aude, JP. It was a pleasure.
Thank you.
Thank you.